Then we have drawbacks of monetary policy. So what are the limitations that we have for monetary policy? So limitation impact on a real variance, because we talk about the issue of transmission mechanism. It's a process, there's a time lag involved in changing monetary policy. May have limitations in influencing the real variables like employment and economic output, because we have to consider other factors, because we need to look at employment and economic output. It's not something that can just be moved by changing policies. There to be other things that have to be considered beyond what monetary policy can do. So we look at the ETS, primarily impacts is often in nominal variables such as interest rates and inflation. But when we look at the other things which have to be considered whenever we use monetary policy, such as things like the real variables like employment, the economic output, the other variables that have to be considered. So we're just looking at the nominal variables other than real variables. Because the real variable can only influenced by monetary policy tools. They have to other things that have to be considered so that we can make change in those economic conditions. Then we have asset price bubble. This did happen in the United States in the early 2000s, whereby there was asset bubbles whereby they kept interest rates for far too long. So when we look at low interest rates, a common tool in expansionary monetary policy, which aim to increase aggregate demand, can lead to excessive risk taking and the formation of asset price bubbles, potentially resulting in financial instability, because housing prices start to increase so by people where the assets start to increase in value. And that's why we end up having a price bubble whereby you've kept interest rate for far too long, which will cause financial instability, which will cause problems whereby people will be indebted, will be deep in debt. That's the issue of asset price bubbles that came as a result of using expansionary monetary policy. Then we have unequal effect. The idea that monetary policy can affect different groups in society unevenly. Because we look at, for example, like we have low interest rate may benefit borrowers by negatively impacting the savers. This can contribute to income inequality. How we look at the perspective that there's a borrower perspective and there's a saver perspective. So when you lower interest rate, what happens? Borrowers benefit a lot, but the savers lose their savings, of which we're looking at the greater percentage of the population are the civil savings, that one will actually have savings in their banks. They're going to be affected, which is going to cause an even in society, whereby we have an equal effect on society, whereby we're looking at widening the gap, increase income inequality. Then we have the zero lower bound. This is whereby we're looking at where interest rates are already very low. And central bank may face limitation in their ability to further stimulate the economy through traditional monetary policy tools. This situation is known as a zero lower bound, whereby they can't be able to move from that from having lower interest rates that have been stuck for far too long. So traditional monetary policy tools cannot make that much more an impact, because we look at that, you look at the history of the financial crisis that happened, where they have to look for other tools such as uh, that is the other tool which was introduced by Bernard Bernanke, the idea of whereby interest rates is relative effectiveness, whereby you have to now look at the monetary policy, whereby you have to look at the money supply. Let's try to stimulate economic growth. That's the situation whereby you end up having zero lower bound, whereby traditional monetary policy tools are no longer effective. That's the process he named was called quantitative easing. So we're going to be looking at that also. What was quantitative easing according to Bernard Bernanke. And then we also look at global spillover effects. So we're looking at action taken by one country's central bank can have spillover effects on other economies. We look at the Lehman Brothers, one of the largest banks in the world. What they did was it was an action that was done by the Lehman Brothers. The bank was located in the US, and they ended up affecting almost all financial crises, bank crises all over the world. So this is how we end up having central banks have spillover effects on other economies, and they potentially leading to currency fluctuation, trade imbalances, whereby you end up having currencies uh, being being fluctuated to a level that the exchange rate will become much more difficult to match and to be able to trade, the trade imbalance that you come up with, affect employment. That's the problem right there. And looking at our conclusion, we want to talk about that in practice, we are looking at the idea that a combination of both monetary and fiscal policy is often used to address economic challenges uh, comprehensively, because we need to know that the side whereby the monetary policy is controlled by the central bank and fiscal policy is controlled by the government. So there's need for government to step in to address some of the economic challenges. That's why we need a combination of both these policies to be able to influence the economic challenges and able to address them. While we look at monetary policy playing a crucial role in stabilizing economies, it is essential to recognize its limitation and potential side effects, prompting the need for a holistic policy approach. Because you have to also consider that because it's a tool that is very important in monetary policy. If you use the tools of interest rate, money supply, and exchange rate, but you have to consider the limitations in mind so that you can also have to find a way in which you can have a holistic policy approach that can be able to rectify some of the economic imbalances in the economy, some of the economic fluctuations that are happening. So with this, I think we'll see you in the next video.